Hello everyone, welcome to today's session. In this session, we will explore one of the most defining economic events of our time, that is the global financial crisis of 2007 and 9. We will trace how a combination of subprime lending, mortgage-backed securities, and complex financial products like CDOs created systemic vulnerabilities in the economy. We will see how moral hazard and agency problems encouraged excessive risk-taking, leading to the collapse of major financial institutions. We will then move on to understand how governments intervene with bailout packages and stimulus programs, and finally, what regulatory lessons were drawn to prevent future financial crises. By the end of this session, I hope you will not only understand how the crisis unfolded, but also the broader lessons it taught us about the financial markets, regulations, and the global economy. So let me begin with giving you a few facts about the 2008-9 recession. So some of the key economic impact with a special reference to US I am highlighting here. One is obviously you know that the recession means the decline in economic activity, contraction in economic activity. So you can see that the GDP, the annual production of goods and services, is declined by 5.1%. Then the unemployment is peaked at 10% in October 2009. And the household wealth, there is a deterioration in the household wealth, fell nearly 19 trillion. And this is mostly due to the collapse of mortgage market, the steep decline in the net worth of housing, as well as the stock market collapse that took place at that time. And in addition, and overall, there is a decline in global trade. It contracted by over 10% in 2009. So this you can clearly see in the figure that the GDP declined by a huge margin, and there is in parallel there is increase in unemployment rate. Coming to the crisis, how this crisis unfolded. It began as a subprime mortgage crisis, that is a crisis in the mortgage market, housing market, which further escalated into a global financial crisis and further triggered into a deep economic contraction, that is recession. Overall, there is a sharp fall in consumer spending, business investment and credit flows, and mostly in the developed countries, and to some extent, to little bit, it reflected in the developing countries as well. Let me now see what are the major causes that led to the financial crisis. So the roots of the 2007-9 financial crisis lay in three interconnected problems. The first one is financial innovation in mortgage markets, which introduced complex products like mortgage-backed securities and collateral debt obligations. So these financial instruments, this is as a product of financial engineering at that time. Due to the financial innovation, they were supposed to spread risk, but instead this made the system more fragile, and it encouraged the stakeholders to take more risk, and it further led to the collapse of the market. And the second one is there were agency problems in lending, mainly by the bankers and other financial institutions. So banks no longer kept the loans they issued, but they sold these loans to a third party. This originate to distribute model they followed, and it encouraged quantity over quality, because they are not much worried about the default risk, because the banks, what they did, that the moment they gave the loans, mortgage loans, and then they sold out these loans to a third party, the third party converted it into a financial product, then issued as a financial instrument in the market and raised money by selling it. So it led to a surge in risky subprime mortgages in the market. Then coming to finally the third part is the credit rating agencies misjudge the risk, often giving AAA rating to securities that were far from safe. As we studied in one of the previous session, that means the credit rating is given from starting from AAA to even the bottom, that is a speculative bond or junk bond. So when the default risk is very low, then they used to get AAA ratings. But here some of the products, even without the credit rating agencies, without really assessing its true default risk, they granted some of the financial products and companies the AAA rating. Actually they were far from safe. This asymmetric information problem meant investors underestimating the danger, because that investors, they rely mainly on the rating agencies rating given by the rating agencies. So this fueling the bubble, and that eventually burst. So actually overall investors underestimated the true risk associated with the mortgage loans, and it led to a mispricing of these assets. Then let me now take you to the how this crisis unfolded, and it's mostly the 2007-9 crisis. It was mainly three stages. One stage is it was a real estate crisis, it was a mortgage crisis, and the second one, then it became further, it led to a financial crisis, a banking crisis, and then thirdly and finally it triggered into an economic recession, that the recession, economic crisis. So simply we can put out three important events. In 2007 it was a real estate crisis, and 2008 it was a financial crisis, and in 2009 it was an economic crisis, that is nothing but recession. The first stage of the crisis began with financial innovations in mortgage markets. Mortgage market means mainly the housing markets. The products like subprime mortgages. Subprime mortgages means mainly the borrowers, normally they are ineligible to get loans from banks, and when subprime means they are high risk, they don't have much net worth. That means mainly the people, those who defaulted, and also their net worth is very low, that means they cannot repay the loan. That's mainly the poor people. And those who don't have a very formal job, those who are working in the informal sector, they were considered as the subprime borrowers. So products like subprime mortgages, actually mainly these housing loans were given to the poor people. Then not only that, there is mortgage backed securities that spread risk across investors. In addition, the collateral debt obligations were designed to expand lending and spread risk, but they actually encouraged excessive risk taking by the investors and the borrowers. So at the same time, you can also see during this period in the US, especially in the US, at this period, global liquidity poured into US market. There is a huge capital inflow into the US economy during this period, fueling the housing boom. The rising demand pushed home prices higher and higher, and the banks began to give more loans to the subprime customers who are otherwise deemed ineligible to get loans from the banks. And because there is, as a result, many people began to get the loans, and as a result, that the demand for housing increased. That actually led to an increase in the housing prices in the market. So then further it creating a bubble because of the increasing demand for housing, because they are all getting loans to buy house. So that led to further escalation in the housing prices. That this is a kind of bubble because the increase in the prices of house mortgages is not because of its true economic foundations, but because already the banks began to give subprime loans, and as a result there is a huge increase in the demand for housing loans. Then as a result, huge increase in the demand for housing, and it all led to a further hike in the escalation in the price of houses in the US markets. And further, after certain point of time, it began to show its true color. That means it began to touch its true economic foundation, because that initially it was simply a bubble, but that was unsustainable in the long run. So you can see here I am showing you how housing prices fuel the crisis. So after the 2001 recession, the mild recession in 2001, the subprime mortgages expanded rapidly, with politicians and lenders promoting the idea of credit access for all. And by 2007, this was a $1 trillion market, and home ownership had reached record highs. And this is mainly because there is a kind of more liberal or the liberal approaches from the politicians and policy makers, because they thought that actually is the time to democratization of the credit. The people, those who are otherwise seemingly less not eligible to get loans from the financial institutions, the government and other policy stakeholders, they began to promote the subprime loans. They encourage the poor people and the subprime people applying for loan and owning houses. So this overall, it raised the US home ownership raised to the historic high, because there is a tremendous support from the policy makers. The banks took it as an opportunity. They began to give loans to each and everyone, whoever is approaching or even calling, reaching out the people directly, offering housing loans. All the banks, they began to, most of the banks, especially the investment banks, they began to offer loans to the subprime customers. So as a result, you know that the prices of this housing began to increase, and the prices you can see here is that it began to increase from 2002 to 2006. You can see that the housing prices became, it hit the peak in 2006 and the middle of 2007. And you can see, suppose you are as one of the customer or one of the borrower who bought the housing loan, for example, $1 lakh, and you know that you got this loan, and because the housing prices keep on increasing, and you bought, and within 1 year you see that the housing prices became 2 times, that it became 2 lakhs. So then you have all incentive to pay back your loan, because you know that you took the loan for 1 lakh, but now the housing prices, the market value of the house, your mortgage, it became 2 lakhs, and after some point next year it becoming 3 lakhs, 4 lakhs. So there is incentive for the borrowers to pay back their EMI. And then also when they pay back all their EMI, they also get additional loan, further loan to buy some more housing. So that means people began to consider it as an investment opportunity. So you can see that over a period of time from 2002 to 2006 middle, you can see how the housing price escalated. So because of the subprime lending and speculation, overall there is increase in the housing prices in the US, and you can see by 2009, but this came at the cost of risky lending. So when the housing bubble burst, you can see that prices fell by more than 30% by 2009. So you can see here it became, this is the peak of the housing prices, but by 2009 you can see that the housing prices became this one. There is a sharp fall in the housing prices. Then what happened, that the borrowers who got the mortgage loan, they now began to realize that the asset value of their houses are deteriorated too fast, and then what they did, that many customers, most of them, they began to default their loan. They know what, in case if they are not paying back the loan, only the mortgage will be acquired by the bank, and they are fine with it, because the housing prices, there is a steep decline. You know that by 2009, you can see if here in the figure, there is a further sharp fall in the asset value of the mortgages, and as a result, overall there is a large number of default of the mortgage loan. And then you know that the banks fell into trouble, because there is the loans that they given extended to these customers, that it became lots of default. There was lots of default, and as a result many bank failures took place. Moving further, you can also see that the stock market also, there is initially there was, you can see that the stock market prices, it has been increasing. There is upward pressure in the stock market, but by 2007 mid, there was a stock market, this is the peak, and after that you can see that there is a steep fall in the stock price. That means market crash happened in 2007. And this is mainly because the investors, those who invested in the mortgage loans, because all the mortgage loans, these are all converted into a financial products. Since the borrowers are not paying back their loans, all these financial products also began to fail, and then as a result, that the banking system began to fail, financial institutions began to fail, and the other those who are involved in this business, all of their share price began to fall. So then it all led to the economic activity also began to fall as a result. That you can see here is that there is a stock market crash, and you can see how steep was the fall from here. That means you can see that this much steep fall in the stock market price. Moving further, in addition, in parallel to this, there was some of the behavior of the policymaker side also contributed to the subprime mortgage crisis. And the Fed, especially the Fed Reserve System, there was a cut in the Fed fund rate, that is the short term interest rate, interbank interest rate. There was a cut in that. So you can see that in early 2000s there was a mild recession. So in order to fight against, in order to counter the 2000s recession, Fed reduced the interest rate 11 times, which was 6.5 in the initial period, then finally it became 1.75. So you can see that when the rate of interest is declining, for the mortgage loans also become very cheap, because that when Fed fund rate declines, in parallel you can see other rate of interest also declines. So this has been reflected in the interest rate, in other interest rate as well. So as a result, there was a cheap credit boom in all sectors of the economy. So you can see one impact is, you can see lower interest rates encourage banks to expand consumer lending. That is one. Second one, mortgages became widely available, fueling a housing boom. In addition, I already mentioned in a couple of minutes ago, the policy makers, especially the government, also in support of encouraging the poor people, especially the subprime customers, also to own housing. So overall, all these led to a rise in subprime lending during this period, because that banks extended credit not just to low risk customer, that is the prime customer whose credit score is very high, not only to them but also to subprime borrowers, that whose credit score is much less. That means high risk customers at a higher interest rate, because already the market interest rate is very low at that time. Then when they are extending these loans to subprime borrowers, they will get relatively little bit high interest rate, because that they are high risk. High risk means they need to pay high interest rate. So this overall, all this created a surge in risky mortgages that would later collapse. Let me now also talk about one of the key important financial instruments that emerged during the early 2000s. So these are called mortgage-backed securities, and it played a central role in the 2008 crisis. So by turning individual mortgages into tradable securities, banks created an investment that seemed safe and profitable. So investors loved them for their high return and liquidity, as I already mentioned, because in the early 2000s, the subprime mortgage, those who are borrowed it from the banks, they were so keen to repay it, because they see that the housing prices keep on increasing. So for the investors, those who bought these financial products, so because as I mentioned, a bank sold out these mortgage loans to a third party, and they clubbed all these loans, mortgages into a financial product, and then they issued it as a financial products into the investors. So initially, as I mentioned, that the repayment was very clear, and repayment was on time. There was no default, and as a result, the investors initially they began to get high return on their investment. and they loved them because of, as I mentioned, high returns and liquidity. While banks enjoyed, what the banks keep on lending to the subprime customers because they enjoy transferring risk of their balance sheet, because they sold out their loan immediately after issuing a loan, this mortgage, then the loan they sold out into a third party. So but this widespread securitization also meant that when US home owners began to default at a later stage, the shock waves were transmitted across the global financial system. So that means, which I mentioned, that actually when the default has taken place, it actually sent shock waves across the sectors. That means including investors and the third party, which I mentioned, and also the banks. Let me now move to one of the most important instruments that magnified the 2007-2009 financial crisis. It's called collateralized debt obligations. So CDOs pooled mortgages into securities and sliced them into tranches with different risk returns. So you can see that these are all cash flow generating assets like mortgages, pooled them together and divided into tranches. The tranches, how these tranches look like, there is AAA rating. Those were the, suppose you just see that among the household, these house mortgages, you just look at the default risk. So initially there was no default risk. So all these loans were categorized into different tranches, different financial products groups, and those who got the AAA, that means that if suppose out of this all the loans, whoever is paying back their EMI initially, that will go to this AAA rated products, and if there is those who are paying later on, that would go to the lowest rated product. Then the AAA tranches were considered safe, while lower tranches offered higher yields. So what rating agencies did here is that rating agencies often gave even risky tranches high ratings, boosting investors' demand. So as subprime borrowers defaulted, the CDO structure collapsed. Even safe tranches turned toxic. So the overall, the banks and investors worldwide face huge losses, and firms are dependent on CDOs when bankrupt. So the repackaging into CDO squared only multiplied the risk and amplified the crisis. So let me show you how does it look like. So CDO means, so just look, these are all the individual mortgage loans. So there are millions of people got the loans. So these are all individual home loans, mortgage loans that the borrowers. So all these mortgage loans, you know that immediately after making the loans, banks, instead of keeping it, giving the debt servicing, all these banks, they sold out these loans to a third party. The third party pooled all the mortgage loans, and what they did that they are mainly investment banks and other financial institutions. They categorize this into is a kind of financial engineering. Actually, these are all only loans, that mortgage loans they made into different financial products, and those who the default risk is low, those loans were categorized into AAA, and the other, you can see that higher the risk, you know that the rating goes down. And then further what they did, that this is initially the security based, the mortgage backed securities, that is called MBS, and then later on the lowest rated mortgage, this financial product, they made into another financial instrument that is called CDOs. Again, this actually is already, these are all lower rated products. This you can see here, these are lower rated products. This has been transferred to another collateral debt obligations, and then again that one they made further tranches. Again this was been rated as AAA, AA, A, and finally the speculative grade, like that. So then you can see here again, here the lowest loss, but in the bottom you can see the first loss. So that means if there is a default out of total loan, for example, out of 100 loans, if there is the 10% there is a default, this default would go here in this group. So that means if there is the remaining, if there is when the crisis magnified, then you can see that suppose there is 80% default, then what happened that these people would suffer, and mainly these people would suffer. and those on the top, these people, and mainly they will be getting their money back, their investment is safe. So moving further, this is how it looked like. So these are some texts. I would suggest you go through this to get more clarity on how does these collateral debt obligations are structured and how they become acted as a structured financial instruments that purchase and pool financial assets such as the riskier tranches of various mortgage-backed securities. Then overall, to simplify the entire crisis, how the different phases, as I mentioned, first one is the mortgage loans, then CDO pool assets into bundle, then they make into different risk categorization. However, as you know that then there is a default risk, then finally this led to the financial crisis. This may look initially more complicated figure, but I would suggest that you go through this carefully, that going through number 1, number 2, number 3, this actually very systematically explain how the 2007-9 crisis unfolded, and starting from the mortgage loan, then becoming MBS, then CDO, then further leading into economic crisis. Then further, by 2008, the financial crisis escalated into a full-blown banking crisis. Banks face huge write-downs. You know that there is a default in the mortgage loan, and sold off assets and tightened credit. Major institutions like I have already listed out here, Bear Stearns, Fannie Mae, Freddie Mac, and Lehman Brothers. Major institutions like all these institutions either collapsed or required massive bailouts. So the ripple effects were severe. Over 465 banks were shut down by the Federal Deposit Insurance Corporation between 2008 and 2012, making it one of the worst episode in banking history. And you can see I am having some screenshot during the newspaper reporting at that time. For example, the Lehman collapse and a shock wave around the world. Then I also showing you the timeline of the 2008 financial crisis. So as I mentioned, initially it was a real estate crisis, then later on how it became a financial crisis, then different events are noted here over in a year period time. To make this one the crisis, one of the factors which I mentioned in the beginning of this session is that moral hazard, because before the crisis, banks assume regulators would not let them fail, because many banks they thought that they are too big to fail, because if these banks fail, it would affect the credit flow in the economy. So as a result, they thought the regulator won't allow them to fail. So the presumption was that some banks were so vital to the economy that they were considered too big to fail. So this belief encouraged risky lending and relaxed standards. And then the agency problem emerged because the mortgage bank brokers that originated the loans often didn't make a strong effort to evaluate whether the borrowers could pay off the loan, since they would quickly sell the loans to investors in the form of mortgage-backed securities. Similarly, borrowers had little incentive to disclose information about their ability to pay. And similarly, commercial and investment banks, which were earning large fee by underwriting MBS and structured products like CDO, also had weak incentive to make sure that the ultimate holders of the securities would be paid off. So as a result, there was information problem grew. Investors couldn't distinguish which product is risky, which product is less risky, and initially housing prices bubble. Initially there was a hike, this bubble, but after some point of time it began to burst, exposing the weak loans. And coming to the government intervention here, the government aimed to reduce the bank failures by offering deposit insurance. Here the idea here is that this guarantee encouraged banks to take more risk. What they thought that if they take more risk and if it succeed, then the banks will be profited, and if they take risk and if they fail, the taxpayers bore the cost through government bailout. So this overall adversely affected the discipline in the banking sector, amplifying the crisis. So I am showing you some of the data to show the magnitude of the financial crisis, the banking crisis. You can see that in 2001, real estate loan was only 20%, but in it became 33% in their portfolio. It became 33% in 2006. And I am also showing you some more screenshot of the studies and write-up on the MBS and the financial crisis of 2008. So this crisis, initially it was in the developed nation, mainly in the US, then it gradually spread to the rest of the world. So it became a global financial crisis. Then the final phase of this crisis is the recession of 2008-9. The banking failure, it led to a contraction of the economic activity because there is decline in liquidity in the with the banking system as well as in the economy. So as a result, you know that the issue began to show the indications of recession. Then further it led to a full-fledged recession. Because with a GDP decline of 5.1% and unemployment with 10%. Coming to the government intervention, in the middle of the crisis, the US government faced a big debate. Should they bail out Wall Street? On September 29, 2008, the House of Representatives rejected a 700 billion trouble assets relief prom, but just a few days later, on October 3rd, it was passed. So this allowed the Treasury to buy toxic mortgages assets and recapitalize banks. So soon after, in February 2009, Congress approved another 787 billion stimulus packages to boost the economy. So overall, thanks to the quick and large scale intervention, the Great Recession, while severe, didn't spiral into the depression as deep as the one that we saw in 1930s. So overall, as I mentioned, because of the bailout package, finally it saved the Wall Street by the Main Street. Then it also created that some lessons that too big to fail. This issue was widely acknowledged, and some more regulations came to reduce the too big to fail problem. So these are the proposed solutions. Break of large financial institution, because if the institution is too large, then it would create the too big to fail problem. So in conclusion, as we wrap up this session, let us recall the key takeaways. The crisis began with subprime lending and risky innovations like MBS and CDOs, which were amplified by moral hazard and agency problems. What started as a housing market issue escalated into a full-fledged global financial crisis. So government intervention through bailout packages and stimulus plans prevented the total collapse, but the episode reminded us that the problem of too big to fail is still very real. Thank you for watching this session. See you in the next session. Thank you.